All right, let's dive straight into this explainer and completely demystify the U.S. individual income tax process. I know, taxes and simple aren't exactly words we usually put in the same sentence. But today, we're going to break down this seemingly massive puzzle using a real-world family, the Halls, as our guide.
Think about it for a second. Every single year, millions of us sit down, plug our numbers into some tax software, and just stare at that final number on the screen. Whether it's a refund or a massive tax bill, we're totally bewildered about how we actually got there, right? We kind of just trust the black box. But understanding that final number is absolutely crucial for your financial health. So to change that dynamic, we're going to follow a 21-year-old tax student named Tara Hall as she helps her parents decipher their taxes.
To get there, we'll be making 5 quick stops on our roadmap: decoding the tax formula, navigating tax deductions, passing the dependency tests, determining filing status, and calculating the final tax.
First up, decoding the tax formula.
Before you get totally lost in the weeds of specific forms or a shoebox full of receipts, you have to understand the big picture. This mathematical roadmap takes us on a very specific journey. Think of it like a giant funnel. It starts at the top with literally all the money you made, your gross income. Then, we subtract some specific adjustments to get down to your adjusted gross income, or AGI. From there, we take away deductions to arrive at what is actually taxed, your taxable income. Finally, we apply your tax rates, subtract any credits or prepayments, and boom, we reach what you owe or get back. It's a highly logical, step-by-step process.
And what's really cool is that this formula isn't just some abstract theory. It is literally embedded, line by line, right on page 1 of the official Form 1040. If you look closely at the math, it totals your income, hits that critical AGI, and drops down to your taxable income. The form itself is literally just a physical manifestation of the funnel we just talked about.
Flipping over to page 2, we see how this all builds to the climax. This is where you apply your tax credits and the prepayments you've made throughout the year, like the taxes withheld from your paychecks, to reveal your final refund or tax due at the very bottom. It perfectly completes our mathematical journey.
Moving on to step 2, navigating tax deductions. Now, shrinking your tax base is how you legally lower your tax bill, but here is a fundamental rule of tax law you absolutely have to remember. Unlike income, which the IRS treats as all-inclusive, meaning they want to know about pretty much everything you earn, getting a deduction is a matter of legislative grace. And what does that mean? It simply means Congress has to explicitly write a law to give it to you. You can't just deduct something because it feels like a fair business expense or a good idea.
What's really interesting here is the metaphor of the line, which actually refers to your adjusted gross income. Deductions are split into 2 different camps. 4 AGI deductions, like certain retirement contributions, happen above the line. These are incredibly valuable because the lower AGI actually unlocks other tax benefits down the road. Then you have from AGI deductions. These happen below the line, where you generally get to choose the higher of your standard deduction or your itemized deductions.
Stop number 3, passing the dependency tests. This next concept is incredibly important for families like the Halls because it directly impacts filing status and what credits you can claim. There are 2 totally distinct pathways here. You have to figure out if someone is a qualifying child or a qualifying relative. A qualifying child, like the Hall's daughter Tara and her younger brother Braxton, requires strict age limits. They must live with you, and they can't provide more than half of their own support. A qualifying relative, on the other hand, has much broader relationship rules. Actually, they don't even necessarily have to be related to you if they live with you all year, but they are held back by very strict gross income limits.
Let's test this out with a real scenario from the Hall household. It involves Rodney's brother, Uncle Sean, who just recently moved in with the family. So, the big question is, can Rodney and Anita claim Uncle Sean as a dependent on their tax return?
Well, the answer is a hard no. Even though Sean passes the relationship test because he's Rodney's brother, his income completely shatters the rules. You see, a qualifying relative cannot have a gross income over $5,050. Sean makes $42,000, so he fails the gross income test right out of the gate.
If you ever feel totally lost trying to figure out who is and isn't a dependent, the IRS actually uses a very specific decision tree for this. You literally just follow the arrows. It brilliantly illustrates exactly why someone like Uncle Sean gets knocked out of the running based on his income, while the kids, Tara and Braxton, flow right through to the yes category.
Oh, and just as a quick reality check for all the animal lovers out there, and I know this is heartbreaking, while your dog or cat relies on you for absolutely everything, they do not have a social security number. The tax code requires a valid ID number, so no, your pet cannot be your dependent. Sorry about that.
All right, let's pivot to Section 4, determining your filing status.
This is basically the foundation that dictates your tax brackets. You absolutely must fit into one of these 5 categories: married filing jointly, married filing separately, qualifying surviving spouse, single, or head of household. This choice is vital. It dictates your standard deduction amount and which tax rate schedule you're going to use to calculate your final bill. And remember, your status is generally locked in based on your situation on the very last day of the year, December 31st.
So for the Halls, since they are happily married at the end of the year, they follow the top path to married filing jointly, which is great news for them because it generally provides the best tax benefits and helps them avoid the highly restrictive and generally unfavorable married filing separately status.
And finally, Section 5, calculating the final tax.
We have officially reached the finish line. Now that we have all our structural pieces in place, let's plug the Hall family's actual numbers into our roadmap. The math lays out perfectly here. Starting at the very top with their combined salaries and a little bit of taxable interest, they have a gross income of $130,600. Next, we subtract a $5,000 retirement IRA contribution above the line, giving them an AGI of $125,600. Then they take the $29,200 standard deduction below the line for married couples. That leaves them with a taxable income of $96,400, which results in an initial tax liability of $11,314.
But wait, we aren't quite done. That $11,000 figure is not what they owe today. Remember page 2 of the 1040? Tax credits directly reduce the tax bill dollar for dollar. The Halls have $2,500 in child tax credits for Tara and Braxton, plus prepayments from their paychecks mean they've actually already paid $10,200 into the system throughout the year.
So when we take their initial liability and subtract those powerful credits and all those prepayments, the Halls are officially getting a tax refund of $1,386. See? By following the formula step by step, that final number is no longer a mystery at all. It's just the logical conclusion of a straightforward mathematical journey.
So the next time you sit down to look at your tax return, I want you to ask yourself, do you truly understand your own math? Or is it finally time to take control of your financial roadmap? By really grasping deductions, dependents, and this overarching formula, you empower yourself to make significantly better financial decisions all year round. Thanks so much for joining me on this explainer, and keep exploring.